Welcome to Shadow of Truth, and today is Friday, June the 24th, and your hosts are Dave Kranzler from Investment Research Dynamics and Rory Hall from thedailycoin.org, and we are very excited to have on the line the president, the founder, the legend, the man, the big yellow hat, Mr. Craig Hemke from tfmetalsreport.com. Craig, how you doing this morning?
Oh, I'm sleepy, Rory. Man, I think I eked out about 5 hours of sleep. I'm running on coffee and adrenaline, but I'm not complaining.
Well, there's no room for complaining today. Because we got BREXIT and we got gold going to the moon. Dave, how you doing today?
I'm doing well, thanks. Craig, 5 hours for me, that's a good night's sleep. Sometimes I dream of getting 5 hours.
Old people like you, Dave, have a hard time. You gotta get up a couple times a night to go wee, all that kind of stuff.
Oh, I see you're pulling the saber out quickly.
Yeah, it's sharp today.
Well, I'm sure everyone wants to hear about your pleasant trip to your in-laws last week, but what's your take on what happened yesterday? Well,
the interesting part of it all is that it sheds light again on the dynamic of the paper markets. I got back from this family reunion trip that was late last weekend, early this week, and I watched all week long, Monday through Wednesday, as gold was down at one point nearly $60 from the high from the close last Friday, and I thought,
Yep.
This is insane. It was as if the market was telling you that the run up in June, or heck, the entire run up this year was solely based on BREXIT. I thought this was nonsense. And I related to everyone on my site that instead what you're seeing is just the same old bank cartel playbook. Anytime that they know that they're trapped, anytime they know that gold is in an uptrend and there's nothing, that they take every step they can. They exploit any news that they can to try to trim price, flush the specs, cover some shorts, and reset things lower ahead of the next up move. I mentioned to everyone how not only is this what you saw in May with just the ridiculous parade of Fed goons being run out to jawbone the dollar higher, as if, there was going to be that guy from San Francisco, Williams, actually stated that he thought there might be 6 more rate hikes before the end of 2017. What? Why didn't somebody call these people on this nonsense? Well, anyway, that was used to jam price lower and cover shorts ahead of the terrible job numbers and the FOMC and price rebound. But this goes all the way back. I gained this whole thing from my my exposure at Zero Hedge back 6-7 years ago. And one of the days that brought me the notoriety that had people telling me to start my own site was the day that QE2 was announced by the Fed. That day, that morning before that announcement came, they were just beating the living daylights out of gold. And people on the site were like, oh boy, this is going to be terrible. And I said, no, this is what the banks do. They try to reset prices as low as they can before they lose because they know they're trapped. That's at least how long the playbook goes back. And so what you were seeing this week was just a repeat of the same old deal. Open interest went down about 20,000 contracts. The banks were desperately covering shorts ahead of what they knew was going to be gold bullish regardless of the outcome. And now instead we've got this major news. I'll shut up for a second, but let me just leave it with this is the most significant financial event since 2008. People should not I'm watching gold trade now at 13.17. Please don't get sidetracked by the day-to-day tick-by-tick stuff. This is a very big deal, and it will continue to move the price, even the paper derivative price of gold forward as we go through the summer and the remainder of this year.
I would agree with that. I think that the cartel is in more trouble than they can manage at this point. I know
yes.
they've got the algorithms and they've got computers, they've got technology on their side. What they don't have on their side is a tidal wave. And that tidal wave, in my opinion, and you can correct me if I'm wrong, but it seems to be building. And once we get into France stepping out the door, Italy stepping out the door, Greece potentially coming back to the table and saying, Victoria Nuland, sorry, we're out the door as well.
Rory, the euro is the second largest, most popular fiat currency on the planet.
Exactly.
And this is the beginning of the end. And you've already got negative interest rates now in Germany out well through 10 years. This will continue to. What are you going to do if you're now a pension fund or an insurance company or a hedge fund or anybody with assets? You've got to put it somewhere, and it's going to go into physical gold. And it's the physical gold that is what's left of it used to prop up the paper derivative system. And so this is a major, major development. And anybody, again, that sits there and thinks, well, the banks are in charge, it's a matter of time till they shake us all out. They're thinking as if we're still in the same downtrend from 2012 to 2015. If the banks were going to raid price and crush the specs and drive price back down, they would have done it by now. Okay, we've been up here now for 4 or 5 months. They can't. All they can do is try to reset price on day to day, or sometimes they'll do it for a couple of weeks in a row. But they are getting smashed. And I want you to think of it this way. You guys are both familiar with the CFTC generated bank participation report. Now, I'm not a big fan of the report. It gives you just one little snapshot. I mean, the banks have all these hedge funds. They all these Cayman Island based funds and do all these different things in the over the counter market and all that kind of stuff. But specifically looking at their COMEX exposure as reported by the CFTC, which again, I'm not going to try to make it sound like they're angels or anything. They put out this report. It's a summary each month of the 4 largest U.S. banks and the 20 largest non-U.S. banks. We're talking in the U.S., J.P. Morgan, Goldman Sachs, Morgan Stanley, and the like. Non-U.S., Barclays, UBS, Scotia, HSBC, all those. All right, the 24 biggest banks. As of the last report, June the 3rd, they were net short 135,000 COMEX contracts. That was June 3rd. Since then, we've had the FOMC, we've had all this other stuff. Going into just yesterday, before all this happened, they were probably net short maybe as much as 200,000 contracts, but just for fun, let's call it 180,000 contracts. Net short. That means for every $10 move, they are getting paper losses of $180 million. We are now up $50 on the day. That's paper losses of $900 million. When we were up nearly $100 last night, that's a paper loss of $1.8 billion. Okay? They are left defending an untenable position. We're approaching the end of the quarter, so that's going to look really good for the bonus pools. Look, all they can do is put good money after bad. And I remind you, that was their strategy all through 2009, 10, 11, culminating in the fantastic near commercial failure, near COMEX blow up in silver in April 2011, when price went from 38 to 48 in 4 weeks as the banks were desperately covering shorts. It was not a spec bubble. Specs were liquidating. The banks were desperately covering shorts. That's where we're headed again. So again, don't get distracted by, little things going on intraday. Keep your eyes on the ball. This is going to be a significant remainder of the year and into next. God, that was a long speech. Should we just stop there? Jeez. God, I apologize to everybody listening.
No,
I've had too much coffee.
Craig, I agree with you. There's something wrong in the gold market that the banks can't deal with, and I'm sure it has to do with the differential between the amount of paper claims on gold and the amount of actual physical gold, and that's available to deliver into those multiple claims per ounce. But everyone seems to be analyzing gold. I think it's even more interesting in the silver market. And I was running some numbers for my mining stock journal that I released last night. And if you look at, well, first of all, the SLV vol lost like 3% of its silver last week. And silver was not even really down during the week. I mean, when I say last week, I mean starting this Monday. Silver was down negligibly, so there shouldn't have been any reason for silver to leave the SLV vault. But then if you look at the COMEX, there's been a stunning depletion in silver at the COMEX. Since January 20th, the amount of total silver that they're reporting to be held in COMEX vaults is down 8.7%, and that's against a 22% rise in the price of silver and a huge run-up in the open interest in silver contracts.
Exactly.
So while the silver open interest in contracts ran up to a record high, which indicates that the cartel was record short outright silver, silver was leaving the COMEX, both eligible and registered.
Yeah.
And then if you look at it since the beginning of April, if you look at just the registered vault, so that's the silver that they're reporting that has been made available for deliveries, it's dropped 66% since the beginning of April.
Yeah.
And that's why I think there's an even bigger problem in the physical silver market than there is in the gold market.
And Dave, you're absolutely right. And again, that shines the light of truth on the scam that the paper derivative COMEX market is. Because as the banks have issued new naked shorts and driven the open interest up now, 60,000 contracts from the first of the year, the amount of gold shown in their vaults has gone down. So it's fraud. They're selling gold they don't have. There's really no other way to put, or silver that they don't have. And think about this. Yesterday, dig this, the final numbers for open interest in silver are in from yesterday up another 6,000 yesterday to a new all-time high of 219,000 contracts. That's what, 1.1 billion ounces of paper silver. Now, the world only produces less than 900 million ounces. So how could, well, they're just hedging, that's what Sister Christian says. Oh, really? So they're hedging now 120% of global mine supply? Or is it just fraud and crime by these banks led by JP Morgan attempting to essentially corner the market and suppress price and defend their positions? Boy, when this blows up, again, it's going to make 2011 look like, just a little pre-event that it was. It is criminal. I don't even like talking about the COMEX anymore, in that I feel like I'm legitimizing it by talking about the action there. Because it's such a scam. It's a complete scam. And it has the price that is allegedly discovered there is the price of the derivative. It has nothing to do with available supply and demand of physical metal. But physical metal gets priced at that level. And so when everybody sits back and scratches their heads and goes, well, what I don't understand is how the gold silver ratio is at 75 to 1 when historically it's about 15 to 1. That alone should tell you how distorted, economically distorted this pricing scheme is and what it's done to valuations of silver. You'd never get 75 to 1 if you were actually trading the physical metal like we had for millennia before 1975. And so that alone tells you how distorted and how uneconomic this system is. So again, it is what it is. What we're waiting for is the ultimate destruction of it. The destruction of it will come as soon as there is any type of delivery failure, not from the COMEX, just anywhere out of London, somebody wanting to liquidate some shares out of maybe some ETF, somebody wanting to get their metal out of an unallocated account and being told that they can't. That will then spiral out of control. This whole thing will finally blow up. And like I said, this event today, if you take the wheel, this just is like Pat Sajak leaning down and spinning that sucker as hard as he possibly can, right? I mean, this is an event that really speeds up the timeline. And so please, everybody, don't get carried away with, well, gold's, $50 off its highs. I guess it's, come on, man. And one more thing about silver. Today is option expiration of the July silver, the front month, delivery month of July silver. we do this every time there's a delivery month where the options are going off the board. You can just simply look at the open interest and you can peg where the banks who have written all these contracts would like price to settle so that they have minimal financial damage. We've been looking at the open interest for a week and said, well, there's no way they're going to allow silver over 18 by the close next Friday, the 24th. Pull up an intraday chart today and take a look at how 18 has been a barrier to silver. And it's 1780 or something as we speak. I'm not buying any silver calls or anything like that today, but I might this afternoon once that option expiration is behind us. If I might continue for a second, the low in the sell-off, the contrived sell-off that broke the back of the previous bull market in April of 2013, the low on June 28th, 2013 was 1820. That level acted as a floor for about 15, 19 months, something like that, before it was smashed in 2014. That level closing back above 1820 and then closing back above the 1850 level on a weekly basis, which was the tops back in January of last year. Once silver gets above there, and it is going there, then I mean, even the most blind, agenda-driven technical analyst is going to look at it and go, "Oh man, that's silver. That's really turned," and that is just only going to further increase the pressure on these banks and accelerate that process that we talked about earlier of the banks finally being forced to panic short cover.
Where's the next level of resistance beyond the, say, 1850 mark? Because if I remember correctly, it's like low to mid-20s.
Yeah, the actual low of the beatdown of April 12th and April 15th of 2013 was 22. And people remember back in the day, I thought, man, that was such a coordinated, manipulated event that I thought, well, okay, that was the peak of the sell-off. It's never going below there. And I even promised a guy I'd eat my hat if it did. And I had to eat my hat. So that was what 22 was. So yeah, once we're above 1850, 22 becomes the next target. But again, just anybody can pull up a weekly chart and you can see the trend change, no doubt about it. That's clear for everyone to see. But boy, once we put on a weekly close back above 1820 and then 1850, it'll be undeniable. I mean, only those technical analysts with a clear, outright agenda to keep silver down will, not talk about it or try to, downplay it. So watch that level. Silver will follow gold, and gold is going higher. And so all of this is going to be playing out in the days and weeks ahead.
Craig, I got one question and then one comment back to the TA analysis of silver. But when you ate your hat, did you put hot sauce on it first?
I did. Anybody can find it. I did. That's exactly what I did, Dave. I filmed it and posted it to YouTube, and I had a bottle of Frank's, and I was dumping it on my yellow hat and tearing it out and taking bites out of it. And there were people that were panicked that were telling me, "Don't eat that stuff. That's made in China. It'll kill you." And I'm like, you seriously didn't see me pulling the bites out of my mouth and dumping them behind me? God bless all the people that were concerned for my well-being. Hey, that's okay. There's a couple of trolls, a couple of them, but that like to point out, oh, this guy said it'd never go below 18. This guy, he also said it'd never go below 1200. Well, I was pretty adamant that it wouldn't. And if any thinking person said, that turd guy, he's pretty smart, and he said it'd never go below there, that must make it a pretty good buy at these levels. Yeah, that's turned out to be pretty solid. And if you've been buying all along, as I have, where we are today is, for me personally, almost a completely break-even point. I'm actually up on my entire stockpile of gold now because I wasn't only buying it in 2010 and 11. I bought it in 12. I bought it in 13. I bought it as recently as about 3 weeks ago.
Yep.
So even with all the premiums involved, and again, it's not about making money anyway. I mean, it's about protection. This is about, protecting myself and my family from the certain destruction of what's coming. But nonetheless, God, you continue to read these stories, oh my God, people, all snake oil salesmen, whatever. Look, even those people are going to end up being saved as prices come back. But that's probably a topic for another day. As long as they didn't sell. You're right, Roy.
Exactly. And if they did, then shame on them. That's
to heck with them anyway.
One thing I wanted to say about the silver, and if you're looking at the weekly chart, you can sort of see there's scant resistance. There is resistance at 2250, but really after that, I mean, they took silver down so quickly starting in April of 2011 that your next major sort of overhead resistance area is not until 35. I mean, when this thing gets turned around, it could turn around quickly. And you pointed out that silver will follow gold, but really what will happen is at some point silver will overtake gold, and silver will be the mule that pulls them both higher.
Yeah, and there's also that point in there. 26 would be a stopping point in there too. 26 was the beat down low and acted as a floor for 19 months in 2011 through 2013. 26 is what they were targeting to take out, just like 1525 was what they were targeting to take out and set off all the stops in mid-April of 2013. So that's another level to watch. But I don't want to. That's the only reason we talk about TA is because so many of these hedge funds and technical funds and stuff, that's what they look at. And that's going to,
they have it programmed into their systems.
Right. So, I mean, I'm not trying to legitimize it or anything like that, but you got to understand, if you want paper prices to rise, you need buyers of the paper. And so this kind of positive momentum generated by the TA or that comes along with the TA leads more and more people and more institutions and trading funds and whatever to buy the paper derivative and force price higher. The other thing I'd mention about TA and the trend change, I can't tell you how many things I've seen in the last, I don't know, month about people saying, oh, yeah, the miners are dead. God, they're not going up, and they're not following along. And, oh, there's this tombstone, doji. I mean, they're coming up with all these reasons as to why the miners are going to roll. Look, if they were going to roll over, they would have by now. And frankly, unless you expect gold to go down, the miners aren't going down. I mean, they correlate about 3 to 1. If you think gold's going to go down 10%, then yeah, sure, the miners are going to go down 30. But you can't just sit there and say, well, I don't know, I think they're overbought. Like you're going to talk them down so you can buy yourself some. Well, the miners are going higher too. And we're going to wrap up the second quarter next week. And in everything from USA to Investors Business Daily, everything else, they're going to list the top performing sectors year to date and for the second quarter. What do you think that sector is? And so all these guys that are desperately seeking alpha, hey, maybe we should start a website and call it that. All these money managers that are desperately trying to find, I mean, what are they going to do? Buy bonds? They don't want to have stocks, maybe. I mean, there's going to be a continual flow of money into the mining sector, into the shares, just simply because it's the top performing sector so far by a long shot in 2016, and they got to put money someplace. So this idea that, there was an engulfing candle and a tombstone doji and give me a break. Just, recognize the value that's there, recognize where metal prices are going, buy yourself, whatever shares you're comfortable with, and then leave it alone. Don't try to day trade yourself out of them, and all that stuff. Just let it go. Anyway, that's my mining share discussion for today.
Physical gold flowing out of Saudi Arabia, United Arab Emirates, into the Swiss refineries and doing something very odd. Instead of going east, it's going west.
Yeah.
We have the situation with the COMEX where the May contract continued to grow even after the option expiry or the first day of delivery.
Yep.
That continued to grow. We're still seeing, just like you guys have just been talking about, these massive swing in open interest.
And Rory, more alleged deliveries of warehouse receipts and warrants on the June COMEX gold, more than 15,000 now. That's more than the previous 6 months combined. Yeah, those are the actual, again, deliveries of warehouse receipts, but nonetheless, as a data point, more deliveries in June than the previous 6 months combined.
Well, let's not forget their warehouse receipts until they take the metal out, and then they're bona fide deliveries, and that's what we've been seeing with silver since April.
Yeah, but again, I just don't want people to think that suddenly the COMEX is going to collapse or something like that.
That's not where I'm going at all.
No, I know. I just want to point it out as a data point, as you were saying about metal flowing west instead of east. Trying to meet this demand. That's just another data point of demand.
All of these things that are combining, and now we have this really massive change in the globalist game plan as far as the Brexit is concerned. I mean, these things are. 2 years ago, I was in an interview yesterday, and I was talking to Bill Holter, and I was pointing out that gold flowing back west out of the Swiss refineries, Brexit, what's happening with the COMEX right now, all of these prominent big name investors coming out and saying you have to have physical gold, period. All of these 2 years ago weren't even on the radar.
Yeah.
None of them. And now they have rapidly become part of the landscape. What kind of changes does all of this encompass? I mean, it seems like there is just a massive sea change that has just happened in like 6 weeks' time.
And that's the key. Rory, do you remember how many times we talked in 14 and 15? And anybody on my site knows how many times I mentioned and drew what I called the nemesis line. Remember talking about that?
Yes.
And there's a line on the weekly chart that marked a clear downtrend channel. And you could see how that line was enforced. Every time we got above it, the banks would slam it back down and get it back below, trying to maintain a downtrend in price. And they managed to pull it off for 3 years. And now we've clearly broken through and we moved away. But all along, what I kept telling people over and over and over, that the key to that nemesis line, why they're enforcing it, is that in the West, the key component of physical demand is the paper price and a rising price. Because if price is going down, I don't want any of that, man. That stuff's just going down. Give me some stocks. Give me whatever. But when it goes up, all of a sudden, here comes the demand. And so price was managed and pressed lower and lower to suppress Western physical demand. It allowed the GLD to be drained of 700 metric tons, all that kind of stuff, because it was all flowing to the east.
Right.
But the key was, once Western physical demand returned, well, then the goose is cooked. I mean, we've already seen 300 alleged tons get added back to the GLD, right? All this other demand that these investors you're talking about, Soros and Druckenmiller and Gundlach and all these guys, all of this now is accelerating. And the banks, which are desperately trying to match up all the orders and flow the gold here and there to try to make sure there's no delivery failures and try to get the gold in if it has to go into the GLD. And then they got to match up their leases because they leased out some gold in a short a year ago, and now they got to get some gold and pay off that lease and then release it again. I mean, it's desperation time.
Yes.
And when that collapses, and again, it's not a COMEX delivery failure. Maybe it would be, I don't know. But somewhere along the line, all these fingers and all these holes trying to hold it back, there's going to be more holes than fingers. And then the whole thing begins to give way.
Well, that brings us to the end of part 1. And if you will click the screen where it says, it will take you immediately to part 2. Thank you all very much.